do you want to buy a home for yourself? Would you like to house hack, become an investor with real estate down the road? Usually the answer is yes, right? And so with my knowledge, I can help them not just get into an affordable home to co-living. I can help change their lives.
Welcome to Truly Passive Income. I'm Neil Henderson.
And I'm Clint Harris. And today we're talking with James Brown. He's an investor and real estate expert who focuses on rent-to-own, co-living, and creative financing. He's the co-founder of Real Home Solutions and has built a career helping people get into home ownership while also creating solid investment opportunities. He's also a pad split preferred vendor and the author of Hybrid Real Estate Investing. James, welcome to the show. How are you, sir?
I'm good. I'm glad to get on here and meet you guys. I think this is going to be good.
Yeah, absolutely.
We're excited to have you on board. So obviously that's a little bit of a brief intro, but we've been chatting before we started recording here. Instead of me summarizing, why don't you give us some basic information about who you are, what your background in real estate is, how you got started, and how you got into so many different creative facets of real estate investing?
Yeah. So initially I had a hard time figuring out which direction to go. Then I partnered up with my business partner, Toby Hansen, in 2019. And we were kind of on the same path of, getting into investing full time in real estate. And, there's so many shiny objects, so many ways to go. But we saw rent to own as a really good one for many reasons. So we got into that and have had multiple mentors and have done different ways of doing it. Finding the buyer first is one of our favorite ways, a rent to own buyer that can't get a loan. We've done it the other way around where we got a property first and then went and found a buyer. So we've kind of done both directions. We talked before, might do a whole other show on that. We've found it's been harder to find good buyers. Once in a while we run across them. But co-living is kind of a bigger trend now and a little bit more viable. So I figured we would talk about that. And let me just back up to just put a pin in the fact that we've raised money for multifamily syndications, the way you guys syndicate, self-storage. So I can speak on that. But yeah, the co-living is kind of where the direction that we're going hard.
So
for many reasons.
So let's back up even a little bit further, James. You had a career as a graphic designer before. What led you from graphic design into real estate in the first place?
Yeah, that was a big shift. Well, I wanted to get into real estate investing just to build wealth. I knew I had to do something besides just the graphic design business. I don't know. I'd actually hired a coach after 25 years of being in the business to help me build my graphic design business, go get more solid, good paying clients. But I got the freaking real estate bug and I was like, my brain was going that way. I was kind of burnt out on the business side of the graphic design. So I just, instead of going all in more on the graphic design, I just decided, because it wasn't getting me where I needed to go, where I could retire comfortably, if at all. Like I just wasn't heading that way without building a whole agency and so.
Yeah. What time period are we talking about?
That was about 2016, 17 is when I was like, okay, I need to get serious about figuring out the real estate. And I mean, before that, even my dad told me when I was in college, she's like, get a duplex, buy it, live in one side. I mean, he's not a real estate guy. He's kind of fumbled into it a little bit, but, he saw the vision and I didn't do that, but I did buy a house with my brother and, started building equity and then leveraged that and bought a house by myself, which I Airbnb'd a room right about 2017, started getting my head around it. But I had also bought that house in 2006 and then the crash happened. I didn't have any equity. Like I didn't build, it took a while, but Denver, where I'm at, it bounced back with enough
And
of
then
a
some.
gain. Yeah.
Yeah.
So I was able to pull money out of that house. Actually sold it. That's a whole other story. Deciding whether to keep it as a rental or sell it. But I ended up selling it and used that money to get our business off the ground.
Yeah, that classic 10-year flip, tale as old as time, to ease your way into real estate. That the house hack that turns into a flip years and years later. It's actually funny. That was my first property. It was the same way. 2010, I bought my first duplex and house hacked. All right, so I want to move forward a little bit. Tell me about. I don't want to spend too much time on the rent to own thing, but I do think that's pretty interesting before we jump into the co-living situation. What's the difference between like a traditional rental tenant and the type of person that a quote unquote tenant slash owner that's the rent to own tenant? Like, what's the difference in those two people and what they're bringing to the table?
It makes such a huge difference, especially for us as investors. So kind of going back to, there's the two ways to do it. The way I like it is finding the buyer first, finding a good solid buyer that we vet them, but we also use a lender to kind of get a second set of eyes on them to see like why they can't qualify and what they need to do to qualify to buy the house from us, with a traditional loan in the future. So, we got to look at everything, credit score, all sorts of reasons why those can be off, their debt to income. They've got to be able to afford it. But the big thing, we're looking for people that have around 10% or more of the purchase price that they can pay up front. They get 100% credit for that when they buy, but it's non-refundable. So it's kind of like insurance for us and skin in the game for them. So when you get 10%, Denver's median price is around 600,000. So that's 60 grand. They're not going to be vacating your property. They're not going to be punching holes in the wall. They're not going to, all of the things that scare us as investors, they're way less likely to do that. And we ask them to take care of most of the maintenance and repairs. So, the things that kill us as investors is vacancy, damage, the maintenance and repairs, the CapEx. That stuff all adds up and can really kill your deal. And so if you've got that person with that owner's mindset, and like in this case, they pick out the house, usually just something on market. So it's not like we're trying to fit them into, a house that's not a good fit for them. They picked out the perfect house for them.
Okay, so they're picking out a house that's on the market existing. I was assuming you're going out and finding distressed properties, renovating them. There's a markup there. You're selling it to them like that. You guys are buying a house that's on market, and then you're either, I guess I'm assuming you're paying cash for that, and then you're seller financing it to them for 10% down. You're offloading some of the CapEx, the vacancy, the maintenance, because they are the property owner. So that's their responsibility. And then you're seller financing it to them for a couple points over the market rate.
Basically, yeah. It's not a owner finance. And yeah, we're buying stuff that's move-in ready, ideally, because we don't want to sink a bunch of money into something that we're not going to get out for years, right? And most of these are 1 to 3 years. We've got a property first one where we gave them a full 10 years, but it'll probably make sense for them to buy somewhere in the middle.
So how do you make money? You're renting it to them, and are they so they are truly renters. You're not selling them the property. You own it. They're there for call it 3 years on a $600,000 house. They're paying you rent during that period of time. I don't know if any of that rent is being prorated towards the final purchase price, but basically at the end of that time period, they're buying the property for a predetermined amount and using traditional financing to take it down.
Exactly. Yeah. A lot to unpack there. So, we typically don't hold it in cash. Sometimes we'll make an offer with cash, but then put financing on it right away. Just so, like during COVID, it was hard to beat out all the other buyers. So we would buy with cash if we could. So yeah, we lock it up then. then we've got a loan on it, right? Whatever interest rate we've got. Of course, we got to put 20% down, and then our rate's going to be higher than a primary home buyer, right? So then we just mark up a little bit more for the rent. So, we've got some cash flow coming in, and then that purchase price in the future, we bump that up. We don't want to gouge anybody. We want it to be fair for both sides. Like, I got to get both sides to agree, right? So we'll look at what the market is doing and what it traditionally does. So like, Denver's around 5-6% traditionally. So we'll have that increase in price each year. So it behooves them to buy it sooner than later, right? Work on whatever they got to do.
Got it. Again, I don't want to pigeonhole you here. I want to ask one final question and then move on to the co-living thing. How do you navigate a current, not historically, but we're currently, if you let recency bias take over, this is a high interest rate environment compared to 2 or 3 years ago. So how do you navigate buying a property 24 to 36 months ago when you're locking in, even you guys are probably locking an interest rate of 3.25 to 3.5% on something like this. So that person's making the monthly payment of a little bit more than your fixed overhead, plus you're reducing it by the 10% capital expenditures and vacancy and everything else that would come along with that. You're passing that on to them. They're paying the utilities and everything else. Okay, so fast forward 2 or 3 years, and when it's time for them to buy the house, they're getting 7% or 7.25%, and now their monthly payment is going to be $600 to $800, maybe $1,000 more than it would have been if they bought it 2 or 3 years ago. What do you guys do? Are you guys extending the note and allowing them to continue to rent, or what do you do when the economics of the current interest rate environment don't make sense for an exit?
Right. Well, yeah. So first of all, we run our numbers both ways, like now and when they go get a loan, because they're typically not going to put 20 or 25% down. So they're going to put, usually 3.5% FHA loan. They're going to get a lower interest rate than we did as an investor. So we kind of look at it, we don't want their payment to go up, because that they might not be able to afford it, right? So we run our numbers that way. And then back to your other point, there's different things we can do. First thing is extend it, because number one, they got to afford it. 2, it's got to appraise, because the lender's going to get an appraisal at that time. So it's got to appraise. So if it doesn't, we can just extend it, and we can adjust the terms. But that's typically what we do, is just extend it till the market comes back around. If they've put down 10%, and like I said, we give them full credit, right? If they go get a 3.5% down loan and closing costs, they still have a little room to kind of bridge that gap if they want to. So those are kind of the two main things.
Awesome. All right. So let's shift focus here. Talk to us about, I know that you're a pad split preferred vendor, which I don't even know what that means. I'm looking forward to you enlightening us. You're also author of Hybrid Real Estate Investing. So outside of that, if we're just talking about the co-living space, what's going on there? Explain to us what that means. We haven't talked about that, with the exception of briefly mentioning it probably a year ago with another interview. Tell us about what that is and how you're seeing that. I'm assuming that's a solution for the current housing crisis that we're in. Kind of unpack that for us and the listeners.
Yeah. Okay, cool. So co-living's simply renting each room separately. The benefit is for us is we can cash flow more. There's more management than, a long-term rental. So we can get into all the details of that. But it's solving the affordability problem for rent, So as an example, like Denver, a 1-bedroom, like a studio apartment's $1,440 is like kind of the median price per month. A 1-bedroom apartment, not a studio, is like $1,600. So with co-living, you can rent a room for $800-900 in this market, and in the Denver market where affordability is a problem. And then you're sharing a bath, unless you can, if we've got a primary bedroom that's got its own bath, they'd pay more, so they wouldn't have to share a bath. But otherwise, you're sharing a bathroom and the kitchen and the common space. But yeah, it's solving that affordability problem.
So I've heard of this strategy with around college campuses a lot. Like there may be a 2-bedroom house. We're in the Southeast, so the prices are way different than Denver. But say you got a 2-bedroom, or excuse me, a 4-bedroom house that's going to rent for $2,000 a month. But you can have that same 4-bedroom it's obviously there's a master or whatever, but it's going to average out to $700 per bedroom, right? So it's $2,800 a month for the same house, but you got 4 different tenants, 4 different leases. And so you can get a pretty significant bump by going by the room. I'm sure that comes with its own unique challenges in terms of culture and having different lease agreements and everything else like that. So this is something that's bigger than just what we're seeing around college campuses. This is a permanent housing solution in Denver. Is that what you guys are seeing?
Yeah. Yeah. We're like pad splits in, they say it's our 21st their 21st market. But if you go on their website, there's even more states than that and other markets in there. So they just keep, kind of branching out. Mainly the major metros.
Is Pad Split offering like furnished properties? What is Pad Split now? What does that product look like?
Okay, so think of Pad Split like Airbnb, like the platform for co-living. Their main thing is finding tenants, so they put money into marketing. So they do the screening, which takes that off our plate. So they do the screening, background checks, income verification, evictions, and so they approve or disapprove people. And then they handle the payments. We can get into the details of that, but it's like they pay weekly for people that. So this is not student housing. This is working professionals, people that can't go afford a 1-bedroom apartment and their car, and so they're usually kind of trying to get out of the whole might be homeless. Like, shoot, we just had somebody move into our place. She was living in her car and it's been under 0 degrees. It was like -7 one night. Oh my God. So it's like a solution for people that are in that position. So yeah, working professionals, not students, of all age ranges. It's usually mid-30s, but that's the avatar. So it's a big group. There's a lot of people that are in that, income level that this is needed. So that's why we're going this way. We're like, it's a need. We're going to fill it,
Yeah. Well, it's an unfortunate side effect of kind of where we are with the housing crisis. I mean, just interest rates and housing costs, and it's just spiraled over the last couple of years. And go anywhere on almost any social media, and you'll see people in that age range complaining about the cost of rent and the cost of mortgages. Are there any regulatory hurdles that you're usually having to navigate?
Yeah, good question. So there's usually a limit on how many unrelated people live in a home. That's nationwide. It's pretty common to see that. Our governor, and there's been a few other states, our governor just 4 months ago passed a law statewide saying there's no limit to how many unrelated people live in a home, because that helps solve this problem. So our timing's great. Pad Split came and spoke at our in-person investor meetup about 3 months ago and asked us to partner with them because they need boots on the ground, people to help investors find properties or analyze and see if like an existing property will work for this. Because there's a lot, like Denver, it's hard to cash flow a long-term rental. Insurance is going up, as we all know. Taxes is going up. It's starting to put a pinch on them. So co-living can be the solution. Now, the caveat is you got to add enough bedrooms and have enough people. So like in Denver, you can go buy something on market, but you're probably not going to cash flow if you only have like 5 bedrooms. You got to add to 6, 7, 8 or something like that.
Wow. That's a lot. That's a lot of people.
It is. Yeah. So like the house that we've got as an example, we just got up and running, just filled it with the 6th person. It's a 6 bed. It's got 3 bedrooms, full kitchen, bath, upstairs and same thing downstairs. So there's way less pressure on the bathroom and bedroom. So when we're adding bedrooms, we want to have at least, we kind of want to limit to 3 bedrooms sharing 1 bath, so have enough. Like Colorado, we've got a lot of basements that we can add bedrooms. Of course, you got to add egress windows. There's a lot of formal dining rooms and stuff where we're not taking away, we like to have a common area. So it's like a home, but not chopping it up. So it's like a hotel, so you got to find the balance so people want to live there.
I think it's obviously really creative to make deals pencil in a time when they traditionally wouldn't, right? Long-term rentals don't make sense right now. Short-term rentals have gotten a lot of pressure by massive increase in inventory. And so you're seeing more people switch to like the midterm rental strategy, the rent by the bedroom strategy, which is great because it changes the dynamics. When the cash flow changes, it makes some deals pencil right now that wouldn't typically pencil. So that makes a lot of sense. In terms of bringing this home for the listeners, the podcast is called Truly Passive Income. I had a background with single family homes and then small multifamilies and then small multifamilies at the beach. We converted to Airbnb and then built a property management company to try to make that a little bit more passive, but it was anything but, because what I found out is with an Airbnb, you have 8 to 10 tenants per month in one listing, right? Now you're talking about a single family home and you got 6 tenants in that one listing. And eventually I got to the point where I'm a huge extrovert and I love people, but the reality is it can be exhausting. And so I had to make the decision of, I was going after financial independence and I got to a point where I replaced my income in medical sales. But about the time that I was ready to just give it all up because of the headaches, I realized what I was really after was financial time and location independence put together. And that small multifamily converted to Airbnb strategy scales pretty well to maybe a dozen or 2 listings. I still have 14 right now, but I'm in the process of getting rid of some of those. It doesn't scale to like 100 or 200 or to hit it's not, the number of headaches that come with it is not linear. As you grow a portfolio like that, you come up with additional positions that you have to put people in to kind of manage that. And so the amount of money you make on 5 of those properties, it's not times 10 when you have 50 of them. It's you have more fixed overhead costs that goes into the process of managing it. And it sounds like Pad Split is awesome of on paper removing a lot of those risks and screening tenants and taking care of the payments and everything like that. What does this strategy look like in terms of, from an investor standpoint, if you got a property that's not doing great right now, it's an okay deal, you could convert it into a co-living situation, probably make it a great deal, in a market where it may not be. And I love that creativity. But for someone that's looking to scale a portfolio to the point where it's going to meaningfully affect their life in terms of the amount of time they spend with their kids or their grandkids, what does it look like to try to scale something like this? And like, let me ask it another way. What are the biggest pitfalls that investors are going to run into when they step into this strategy? Pad Split sounds great. Outside of that, sounds like the number of bedrooms and bathrooms is thinking it's going to work with a 3 or 4 bedroom in your market is a mistake, right? It needs to be probably 6 bedrooms or more to make it make sense. That comes with its own challenges in terms of dynamics. But like, what are some of the major pitfalls? And is this a strategy that you think it has the opportunity to scale for an investor who's looking to build a more passive portfolio?
Yeah, I need to get my head around that. Definitely, you got to have a team to scale it. I know a guy that has about 150 of them. Of course, he's got a team. So, yeah, the logistics of getting that, so you're not just running yourself ragged with all the communication and stuff. That would be a challenge. But I know people doing it remotely. We're just starting here in Denver, but getting our systems together, and most of it's remote. Like I'm doing all the management, getting members. They're actually members with Pad Split. So yeah, it's time consuming, mostly up front though. So there's a heavy lift getting it all furnished, keyless entry on all the doors. We put security cameras in the common areas so we can kind of keep an eye on, at least have recordings in case we got to go back and say, yeah, you didn't do your dishes. It gets down to that kind of stuff. So it's not passive unless you're an investor and just hire the management. And so it's generally about 20% for management. Like Airbnb, if you're going to have somebody manage it, it's going to be more than that. Not 10% or 8%, like a long-term rental. So we just run that, put that in our numbers. Plus, these are furnished, all utilities, Wi-Fi, everything's paid. So the members have one payment and they don't have to worry about making multiple payments. It's just one, keep it real simple, bill them once a week. But yeah, for scaling, it's always a heavy lift, finding a property, getting it all converted, getting all the furniture and everything in, and then getting it leased up. Like that first, like we just got our 6th person into this one here in Denver. It took surprisingly a short amount of time. Like we got it online around Christmas in the middle of winter, trying to get something leased up. And we were like, oh God, this could be, a while. And so we run our numbers like it might be vacant or partially vacant for 3 months, but we're up, which, proves that there's demand here. So
I love that there's a survey about the 2020s that I've read recently. They did the same survey on the previous 10 years, and the previous 10 years, the most important characteristic among successful investors in general and business leaders and real estate investors was emotional intelligence and being able to connect with people and understand their needs and goal alignment and things like that. In a fast-paced environment for this current 10 years, according to all the people having a lot of success in that space and business leaders, when they poll them, the most important thing right now is adaptability. We have a rapidly changing market, and the ability to adjust in that market has eclipsed the need to help, people understand how that they can best accomplish their goals. That comes along with the emotional intelligence. Now it's, hey, your goals aren't realistic in this market unless we change some things. So what can we change to listen to what the market is giving us and adapt to that situation? So I love that side of things. In terms of changing the conversation a little bit, you talked about raising capital and ways that investors can partner on things like this. So talk to me about, from an investor's perspective, the types of deals. I know you've done multifamily deals in the past, but with everything that you understand about what the market's giving us, the economic headwinds, the high interest rate environments, having to make a shift to things like co-living, what are the opportunities that you're seeing in the market constraints that we currently have? And where do you think the opportunity is for investors? Tell us about the type of money that you're raising for the types of deals that you're doing. And what are you focused on in the future? What are you bullish on? Where do you think the opportunity is?
yeah, for now, for sure, the co-living, rent to own too. Like we talked before we started recording, the big players, Home Partners of America and Divvy, backed by BlackRock. Home Partners they're pulling out just because of the high interest rate environment. We can still make it work. It's just much harder. They may come back, but yeah, the co-living, there's a lot of people that just, like I said, can't afford a 1-bedroom apartment nationwide, so that's what I'm bullish on. And, I'm kind of pivoting or leveraging this. Like when I have conversations with new members of our homes, they're in a tough spot for whatever reason. And so I'm starting the conversation right away. And I say, hey, what do you want to do? Do you want to buy a home for yourself? Would you like to house hack, become an investor with real estate down the road? Usually the answer is yes, right? And so with my knowledge, I can help them not just get into an affordable home to co-living. I can help change their lives. Might take a while, but like we've got this guy, he's a data analyst. He's young. He's in his 20s. He's saving money by staying in this co-living home. And so eventually he's going to be able to buy his own home, probably house hack. I can help him set up a co-living house if he wanted. So that's my goal.
Yeah. I want to wrap this up and talk about, I would say what we're all kind of agreeing here is the opportunity over the next couple of years is probably in affordable housing. It's really kind of what this boils down to. You look at, I see articles all the time about, there's this direct correlation between homelessness and the cost of living in a community. The areas that have the highest home costs, the highest rents also have the highest incidences of homelessness. And so what you're doing is, on one hand, you're solving it just short term, somebody who just needs an inexpensive place to live. And then I love that you're also trying to educate people on, hey, I try and talk to cousins of mine all the time who complain about, oh, I can't buy a house right now. Well, like, are you just trying to buy it like a 3-bedroom house all on your own, expect that you're just going to live there right now? Like, buy it with the intention of renting out the rooms, and now you'll be able to afford it. And I love that you're taking that a step further when you're talking to these tenants, is you're not just providing them a place to live, you're also kind of educating them on, like, you could do this.
Yeah. I'll be inviting them to our house hack meetups and webinars and stuff. So
there you go. That's the way to do it, man. That was my first house, was a house hack when we moved to the beach in 2017. We did an Airbnb house hack that was a duplex. It's just the way that it has to happen. Like, our parents and grandparents could save their way to retirement. I say it all the time. People these days can't do it anymore. You can't get there by saving. You have to play offense. If you're going to be playing offense, the same strategies of wholesaling and flipping houses that worked 5-10 years ago don't work right now. The same things that work in a 3% interest rate environment don't work in a 7% interest rate environment. What doesn't change is change, right? The market is always going to give you something different. And just because something doesn't work, that doesn't mean that you should sit out all the time. Maybe it should. Maybe if it doesn't fit in with your wheelhouse and your skill set, maybe you should. But the reality is, I promise you, someone out there is operating in these economic headwinds. And it's a classic who, not how situation where you don't need to know how to do that or how to get a house or how to find anything. What you need is a who. If you find a who that can help you navigate rent to own, co-living, whatever it may be, creative financing, someone that can be the bank for you, at least for a short period of time, you can find ways to continue to move forward in a market that has strong economic headwinds. And I think that's where we are. That's the reality is there's never an excuse to stop looking for ways to meet the goals that you have for your life. Your only other option is to change your goals. And if you want to change your goals and like lower the bar for yourself, you can do that. But I would encourage you not to lower the bar and focus on finding the person that can help you navigate that. And maybe you have to get creative, but the reality is you're marrying the property, you're dating the interest rate. If you get into the right one, there's a good chance you're going to be able to refinance later and create equity in the meantime. So certainly, in order to pull all that off, it's very unlikely somebody's going to have the opportunity to do that their own, especially with a first house. So they need a James Brown, right? They need somebody that can step in and fill those gaps for them and kind of like shorten that need gap, right, between where they are and where they want to go. So James, for the listeners that are interested in potentially investing in that kind of strategy or talking to you more about placing capital or what that looks like, we're seeing if those metrics are something that might work in their market. What would be the best way for people to reach out, connect with you, and find out more about what you're doing?
Go to Linktree/partner with James Brown. And I've got a bunch of links on there.
That's perfect. Yep. We'll drop that in the show notes. Make sure people are able to get in touch with you that way. So, all right, James Brown, appreciate your time. Thank you so much for sharing on something that we haven't really dove into and talked about. So, given the economic headwinds, it's nice to be able to just look at some of the problems and find the people that are providing solutions. So thanks for sharing on that. We appreciate your time.
Yeah, awesome. Thanks.
Thank you so much for listening and watching the Truly Passive Income podcast. If you liked the show, if you think it would be useful for someone else, the greatest compliment that you could give us would be to share the episode, leave a comment down below, or leave us an honest review. If you have any questions, don't hesitate to let us know down below. And remember, with truly passive income comes freedom of time, place, and the freedom to pursue your higher purpose.